welcome back to another video with Grand Majors Academic Support Services. Today we'll be looking at CVP analysis, right? And you might ask, what is CVP analysis? So here's a few key points. So it's an abbreviation that means something. So C is for cost, V is for volume, and P is for profit. So CVP analysis, cost volume profit analysis, speaks to the behavior of total revenue and total cost and income. And as changes occur in the output level, selling price, variable cost per unit, and or fixed cost. So it looks at the behavior of all these variables, revenue, cost, income, as changes occur in the output level, as changes occur in the selling price, and as changes occur in your variable cost per unit and or your fixed cost. So managers use CVP analysis to help answer questions such as, how will total revenue and total cost be affected if the product volume changes? And what this is, if how much you produced changes, that's what we're considering product volume, right? And questions such as cost in relation to volume and profit changes in relation to volume. So as volume changes, what happens to cost? What happens to profit? So that's the purpose of CVP analysis. The focus of CVP analysis is on break-even point, right? And what is break-even point? This is where, this is where your sales level, right? And there's two considerations. You break even, and if you're supposed to think about it in layman terms, what you mean by break even, right? It is where your total, where your total revenue is equals to your total cost, or two, where operating income is equal to 0. And that's really repeating itself, because if your revenue is equal to your cost, your profit is 0, your operating income is your revenue minus all your costs. So if that is 0, it means you are breaking even, right? You're just there making enough money to cover your costs, essentially. Is this a good thing? It depends. It's not the best thing, because business don't go into business to break even. Business operate to make a profit, right? But it is good if you can break even. It's better to be breaking even than to be making a loss. Because if you're making a loss, which we'll go to a little bit, you'll see, it means that you're not breaking even. You can't even pay for your costs, and that is doubly bad, right? So I'll say, start at breaking even. So the next point is, if sales is below break even, or the break even point, that results in a loss. You're operating within a loss. But if sales are above the break-even point, you're operating within a profit. So you're saying, okay, you want to be above break-even. So considering these few points, let's go into our question for today. So it says, Gordon Steel Parts produces parts for the automobile industry. The company has monthly fixed costs of $640,000 and a contribution margin of 80% of revenues, right? Company has monthly fixed costs, just reading that, of $640,000 and a contribution margin of 80% of revenue. You might ask, this is a little bit of information for 3 requirements, but let's just look at them. So the first requirement, compute Gordon's monthly break-even sales in dollars. And they're telling you what to use the contribution margin ratio approach. Use the contribution margin ratio approach. And we would have done contribution margin in our last video, right? So this should come a little bit easier. If you haven't checked it out, please do so. Again, use the part 2, use the contribution margin income statement to compute Gordon's monthly operating income or operating loss if revenues are 500,000 and if they're $1 million. So here we have 2 scenarios, right? What are we going to be making a loss or revenue if or operating income is 500, or if it's 1,000,000. So we'll be looking at that, right? And the last requirement says, do the results in part 2, right? So in part 2, we were given a scenario, and we're supposed to be saying, would we be making an operating income or a loss? So the results from that, does it make sense given the break-even sales that we are going to be computing in part 1, right? So you see now, okay, we could have gotten 3 questions, right? So all these intertwine. So from doing part 1, where we're finding monthly break-even in sales, and to note, break-even can be in units, because you need to know how much units you need to produce and sell in order to break even. And multiplying that by your selling cost. I'm giving away this part here, but multiplying that, you know how much should your break even in sales in dollars look like, right? From finding that, we go and we work out the scenario, and then we'll tell how that looks like. So today we'll be working on a whiteboard, so you'll be able to see it even clearer. Before, we were working in a PowerPoint where I would have done the questions but we'll be going through it today step by step. So stay tuned and we'll be getting that done. So let's go back into the question, right? So we're working with Gordon Steel Parts, an automobile company in the automobile industry, right? But based on the question, let us start off with, what do we know? So the question gave us 2 pertinent information, right? The part, so it's an automobile company, like that's not our figures, right? But it's essential to note. But in terms of numbers, right, it told us 2 things. It told us that fixed costs, right? It told us that our fixed costs were $640,000, right? And it tells us also that our contribution margin, I'm gonna abbreviate that, right? It told us that our contribution margin is 80% of revenue, right? So knowing that, what can you go ahead and do? Not much as yet. So let's go to what the question states. The question states to compute Gordon's monthly break-even sales in dollars, right? And it specifically told us to use the contribution margin approach. So there's more than one way that you can find break-even, right? You have the equation method, the method that they're asking us here, which is the contribution method. And you also have the graphical method. So they're asking us to use the contribution margin method, right? So from our last video, how do we find contribution? We would have known that to find contribution is found, right, by sales less, or sales less, or what? Or total variable cost, that gives us our contribution margin, right? So it tells us, the question says that our contribution margin is what? 80% or 0.80, 0.8, right, of sales. So if to find contribution, it's sales less variable costs, it would mean if this is 80% of sales, this would mean that our sales is 100%. And as our formula states, sales less variable cost gives us contribution margin. So if you can use changing subject of the formula, right? If this is 100, this would be X, or total variable cost, gives us contribution 8%, 80%. This would therefore mean that your variable cost is what? 20%, because sales minus variable cost gives you contribution margin, right? And if your contribution margin is 80%, right? Your sales is 100%. What does that mean? That means your variable cost is 20%. So just based on that one information that we got, right? We have a lot more information to properly answer our questions. So using this, I believe we can now answer at least part one of the question where it asks us to find break even in what? In dollars. So how do we find break even in dollars? What is our formula? So the formula for break even, right, in dollars, using the contribution margin rate, is total fixed cost divided by your contribution margin ratio. And the ratio is your percentage, the 80% in a decimal, right? And 80% in a decimal ratio, 0.80. That is why I had it there. So knowing this formula, we can now find our break even in dollars. So what's our total fixed cost? Our total fixed cost was what? $640,000, right? And we're dividing by 0.80 or 0.8, whichever you would like to call it. So why did I remove that? So we are going to put that in our calculators. And what did we get? So our break even in dollars is $800,000. So there you have it. We would have answered part one of the question, right? Using the contribution margin ratio, this is our break even in dollars. What did we know? We knew fixed costs. We knew that contribution margin was 80% of revenue. But just by itself, some might not have known what that meant. Hence why we did our table here. We know from marginal costing that contribution margin is found, sales minus variable cost gives us contribution margin. So our contribution margin is 80%. Our sales is 100. So our variable cost is going to be 20, right? So having answered part one, let us go to part two of the question. And part two was where it gave us a scenario. And it says to use the marginal income statement, right, to compute what monthly operating income, or if it's an operating loss, would be if we had revenue sales of, it gave us two conditions, 500,000 and $1 million. So let's do this. So we're doing the contribution margin income statement, the contribution income statement for the company. And remember, in accounting, we always have our headings, and this is what I'm doing here. For the period, and whatever the period was, you would have put it there. So we're using the contribution income statement, right? So from our marginal costing last week, we know what that looks like. And we have the top part here. It's sales less total variable cost, right? That gives you contribution margin. And from contribution margin, right, you then subtract what? Your total fixed costs. And from that, you will know if you have an operating income or an operating loss. So let's put this together. So we're going to start with if sales was what? 500,000, all right? Because that was the first scenario. So if our sales is 500,000, right? All right, what's gonna be our variable cost? You do have the information, check again. So remember that this entire question is linked. So this is why from the beginning, we calculated, we did that little sales, 100%, variable cost 20%, contribution 80%. So that's the information that we're going to use. And even if we don't have the variable cost, we knew that contribution was 80%. So whatever we got for contribution there, we could have worked it either way. So our variable cost is 10%, 20% of sales, right? So 20% of 500,000, that is 100,000, right? We subtract that, we're gonna get a contribution of 400,000. Why am I writing that? Now, what is our total fixed cost? From the beginning of the question gave us that, right? So our fixed cost is $640,000. So 400,000 minus 640. We're going to be getting a negative figure, right? We're going to be getting negative 240,000. All right. So we would have worked this scenario at 500,000. What does this look like in the other case, right? The other case was 1,000,000. So this is 2 times the 500. So our variable cost is gonna be 200,000. 20% of 1,000,000, 200,000, right? This therefore makes our contribution margin 800,000, and everything here is gonna possibly be 2 times, right? So then our fixed cost, remember, fixed cost remains fixed no matter what. It's still gonna be, so whether or not our revenue is 1,000,000 or 500,000, your fixed cost is still gonna be 640. So we do that there, subtract, and what is our total here? So 800,000 minus 640 gives us 180,000. So let me draw some lines so we can clearly see what this looks like, right? So let's look at what it looks like. So I hope it's a little bit clearer for you. So you see where the lines are, you know, when you pause, this is where the statement has ended, etc. So lines are a little bit over the place, but bear with me. So we're seeing here, we're okay. If sales were 500,000, right, we'd be making an operating loss of 240,000. Whilst if sales were what? 1,000,000, we'd be making an operating income, a profit of $180,000. So we would have answered part 2, right? Part 3 is more reasoning, where it says, so do these results, this 240 here, this 180, do they make sense given that our break even is $800,000? Does this make sense, right? So let's try to answer that. Does it? What do you think? Before we go through it, because does it make sense in your estimate? What are you thinking? Let me know in the comments, right? Send me an email, DM us on Instagram. Let us know. What are you thinking? Does it make sense? And even after I've told you the answer, let me know if you think what I just said made sense as well, right? So let's look at if it makes sense. So how I'm gonna do this is I am going to put if we were breaking even in the middle. So if we were breaking even in the middle, what does that say? So it says that your break even sales 800, right? And that's between 500,000 and 1,000,000. what would be our variable cost, right? What is our variable cost? Variable cost is what? 20% of whatever our sales is. And 20% of 800,000 is what? 160, right? So your contribution is gonna be 640, right? Let's get that over. And our fixed cost is 640, right? So therefore, our operating income is 0, right? So we're really saying, okay, yes, this is actually a break even, right? But does it make sense? What did we say? We said that anything, if sales is below break even, we're operating within a loss. Are we operating within a loss here? Yes. And if sales is above break even, it means that we should be operating within a profit. So therefore, this scenario makes sense because 500,000 is less than 800,000. So our sales is below break even. And we're proving that to be that we're making a loss here, a loss here. And 1,000,000 is greater than 800,000. So therefore, this is greater than our break even, and we're making a profit. So to answer the question, yes, what we calculated based on our scenario in part 2, right? It does make sense given the break-even sales we computed in part 1, which is $800,000. So give it some more thought, right? Give it some more thought. Let it soak in a little bit, but we have reached the end of our question. So as I said, we have reached the end of our question. Remember to like this video, share it with anyone who you think might find it useful. Subscribe to our channel and help us to grow our community. And particularly, I want to hear your views. I want to hear your comments, especially that last part. Did it make sense to you? Are you understanding it? Do you need another video? Right? Always remember that you can reach out to us via email, grandmajorsacademic@gmail.com, or you can DM us on Instagram @grandmajors. So until next time, for another question.